Many people believe a dangerous myth. They think investing is a game of picking winners. They hear a hot tip about a revolutionary new company. They see a stock soaring on the news and feel the urge to jump aboard before it is too late. They harbor a secret hope, a belief that, with a little bit of luck or special insight, they can outsmart the market and get rich quickly. This is the siren song of Wall Street, a narrative that benefits the brokers and the speculators far more than the average individual investor. It is a story of exciting myth, but the simple, undeniable math tells a very different and far more reliable story. Visual emphasis. Myth. Visual emphasis. Math. We will set aside the thrilling stories of overnight fortunes and instead focus on the cold, hard arithmetic of investing. The goal is not to chase fleeting excitement, but to build sustainable, long-term wealth. We will examine the two primary paths available to most people: buying individual stocks, investing in broad market index funds. The comparison will be straightforward, avoiding complex jargon and focusing on what truly matters to your financial future. This is not a guide to getting rich overnight. It is a guide to getting wealthy slowly and surely. The core of our discussion will revolve around a few fundamental principles: impact of costs, importance of diversification, reality of market returns, role of human behavior. Each of these elements plays a critical part in the final outcome of your investment journey. Understanding them is not difficult, but ignoring them can be incredibly costly. The difference between a successful investment experience and a disappointing one often comes down to grasping these basic truths. We will use simple numbers and clear examples, stripping away the complexity that so often clouds the world of finance and leaves ordinary people feeling confused and intimidated. Ultimately, this essay aims to provide more than just information. It seeks to provide a clear, actionable framework for making sound investment decisions. We will dissect the common fallacies that lead so many astray, trying to time the market chasing past performance. We will then lay out a practical plan that almost anyone can follow, regardless of their financial expertise or the amount of capital they have to start with. The journey to financial independence should not be a frantic race, but a steady, disciplined march. Let us begin that march by looking at the facts, guided by the unwavering light of simple arithmetic. Okay, let's go. First, let us define our terms with absolute clarity. What is an individual stock? When you purchase a share of a company's stock, you are buying a tiny piece of that business. You become a part owner. If that specific company succeeds, innovates, and grows its profits, the value of your share is likely to increase. You may also receive a portion of the company's profits in the form of dividends. The appeal is obvious. If you correctly identify a company like Apple or Amazon in its early days, your initial investment could multiply many times over. This potential for immense reward is the primary allure of picking individual stocks, a pursuit that requires diligent research and a stomach for volatility. Just as a company can succeed spectacularly, it can also fail catastrophically. A single bad product launch a disruptive new competitor. A management scandal can cause a company's value to plummet. In the worst cases, a company can go bankrupt, and the value of your ownership stake, your stock, can fall to zero. To be a successful stock picker, you are not just betting on a business to do well. You are betting that it will do better than the thousands of other businesses competing for capital, and that its future success is not already reflected in its current price. It is a challenging and demanding endeavor. Now let us consider the alternative, the index fund. An index fund is not a single business, but a large diversified collection of businesses. It is a special type of mutual fund, or exchange-traded fund, designed not to beat the market, but to be the market. It does this by holding all the stocks that make up a specific market index, such as the famous S&P 500, which represents 500 of the largest corporations in the United States. When you buy a share of an S&P 500 index fund, you are instantly buying a small proportional piece of all 500 of those companies. In the world of investing, you get what you don't pay for. This is a truth that cannot be overstated, yet it is frequently ignored. Every dollar you pay in fees, costs, or commissions is a dollar that is no longer working for you. The relentless tyranny of compounding costs is a formidable enemy to your long-term returns. When you actively trade individual stocks, you may face brokerage commissions for each transaction. More significantly, in an actively managed mutual fund, you pay a higher annual fee, an expense ratio, for their supposed expertise. These fees may appear small. 1% or 1.5% per year might seem trivial. This is a dangerous illusion. Over an investing lifetime, that small percentage devours a staggering portion of your potential wealth. Fees are charged on your entire growing balance, year after year, a constant headwind. Index funds offer a powerful solution. They buy and hold the index, so costs are exceptionally low, often around 0.10% or less, some approaching zero. Imagine you and your neighbor each invest $100,000 for 30 years. You both earn a hypothetical 7% average annual return before fees. Your neighbor invests in an active fund, charging a 1.2% expense ratio. You choose a broad market index fund with a 0.05% expense ratio. After 30 years, your neighbor's investment would grow to approximately $528,000. Your investment, however, would grow to about $750,000. That difference of over $220,000 was consumed by costs. The math is clear. Costs matter, and they matter enormously. So remember that. There is an old saying in finance that diversification is the only free lunch. It can reduce your risk without necessarily reducing expected return. Owning a single stock is the epitome of non-diversification. Your outcome hinges on one company in one industry. Even if you do your homework, risks you cannot foresee remain. A key executive's sudden departure, a new and disruptive technology, a change in government regulation that harms that specific industry. Unsystematic risk can be devastating. Buying a handful of different stocks is better than one, but still far from true diversification. Even with 10 or 20 stocks, concentration remains. A sector downturn can hit you hard, and a few poor performers can drag down returns. A common and disappointing experience. This is where the index fund shows its structural superiority. By design, a broad market index fund gives instant, profound diversification. Pyramid visual, 1 stock, 20 stocks, total market index fund. An S&P 500 fund gives you ownership in 500 companies across every major sector. A total stock market fund goes further. Thousands of companies, large and small. With this diversification, any single company's risk becomes trivial. If one company in the index goes bankrupt, its impact is almost imperceptible, cushioned by thousands of other businesses. This eliminates company-specific risk. You're still left with market risk, the whole economy risk that can't be avoided. By diversifying broadly, index investors take only the unavoidable market risk, for which they are historically compensated with long-term returns. They haven't paid extra for this benefit. It's built into the product. It is indeed a free lunch, and it would be foolish not to eat it. The allure of stock picking is the pursuit of extraordinary returns. Investors dream of finding the next big thing and riding it to incredible wealth, far outpacing the humble returns of the overall market. Outlier stocks do exist, but the problem is probability. Identifying the few big winners in advance and avoiding the many laggards is monumentally difficult, even for most professionals. The historical data is overwhelming. Over decades, most actively managed funds fail to outperform their benchmarks, such as the S&P 500, over long periods. They fail after costs are taken into account. Gross returns may look strong, but fees and trading costs reduce the net to below simple index funds. If full-time professionals can't consistently beat the market, the odds for part-time individuals are slim. The market's return is the average of all its parts. For every dollar of outperformance, there's a dollar of underperformance. It is a zero-sum game before costs. After costs, it becomes a loser's game. Collectively, active investors must underperform by their total costs. By accepting the market's average return through a low-cost index fund, you position yourself to outperform the majority of active investors. Imagine an index of 500 stocks. Over 20 years, maybe 25, are tremendous successes driving the majority of total gains. Another 100 fail or underperform. The rest fall in the middle. An active manager must find enough of those winners to overcome losers and fees. The index investor simply holds all 500, capturing the full return of the massive winners, which more than compensate for losers, ensuring the market's powerful long-term average return. It's a sobering reality. Beyond costs and returns is human behavior. Investing in individual stocks is a significant commitment of time and effort. Reading annual reports and financial statements, analyzing competitive landscapes, following industry news, listening to earnings calls, constantly reassessing prospects. For some, it's an enjoyable hobby. For most with careers, families, and obligations, it becomes a burdensome second job. The index fund demands almost none of your time. Buy a broad market fund, add to it systematically, and then do nothing. No reports to analyze, no teams to scrutinize, no headlines to react to. The structure does the work for you, freeing your time for career, family, and life. Perhaps the greatest challenge is managing emotions. The market is volatile. Fear and greed dominate. People panic sell low and chase buy high. This destroys returns. Buy and hold indexing counters these impulses. Trust the market as a whole, not short-term moves. Owning thousands makes storms bearable. No decision to make. Stay the course. By avoiding emotional mistakes, you capture the market's full long-term return. Given the evidence, what's a sensible plan? The answer is simple and accessible. The foundation: broad market index funds. This is the core recommendation. For most long-term capital, a total stock market index fund or an S&P 500 index fund. This aligns you with long-term economic growth. Example: invest $300 every month into a total stock market index fund. Some months the market is up and $300 buys fewer shares. Other months it's down and $300 buys more. Over 30 years at a 7% historical average, contributions grow to over $360,000. You contributed $108,000. Roughly $252,000 is market return. This is the simple, powerful math of consistent, low-cost investing. While index funds should be your core, there can be a place for individual stocks under specific circumstances. It requires genuine interest in business analysis, dissecting financials, understanding competitive advantages, evaluating management. Treat it as an engaging hobby, not a primary wealth strategy. If you venture in, set clear rules. Strictly limit capital to individual stocks. Follow a core and explore approach. Prudent portfolio: 90% core, 10% explore. Keep the core, about 90% or more, in low-cost index funds. Use the small explore slice to pick stocks. Protect primary goals like retirement from stock picking risk. Be prepared for significant loss. Stocks can go to zero. Only use money you can afford to lose. Even professionals pick failures. Amateurs should expect no better. Let Explore be about learning and engagement. Profits are a bonus. Expertise can help in a niche, but treat any edge with humility. You're up against the market's collective wisdom. After examining the evidence, the conclusion is clear and unambiguous. For most investors, indexing versus stock picking is no contest. The math overwhelmingly favors index funds. Capture the entire market's return at minimal cost, and you're likely to outperform most active participants over time. This isn't complex theory, it's basic arithmetic. Own the entire haystack, don't chase the needles. It's common sense over costly speculation. Therefore, invest the core of your portfolio in a broad market, low-cost index fund. Choose a total market or S&P 500 index fund from a reputable provider and contribute consistently. Let American business be the engine of your portfolio. If you wish to pick stocks, use only a small, speculative slice you can afford to lose. Treat it as learning or a hobby, not your core retirement strategy. Anchor wealth in diversification and low cost. Satisfy curiosity while staying on track, guided by math, not myth. Successful investing isn't about being clever or finding secrets. It's about discipline, patience, and harnessing the power of the market itself. The market is a powerful wealth engine, but many squander it trying to outsmart it, incurring high costs and emotional errors. The simple index fund lets you sidestep that game. By buying the market and holding it forever, you turn the market from adversary into partner. That is the only investing guide you will ever truly need.